Welcome all subscribers to the Nightly Market Intelligence Report. This is Jeff Killian, Chief Market Strategist here at the Inside Technician. And we have an exciting report to deliver over tonight. One more report we put a lot of time into. We have called the market turning points. We have the turning points nailed on the ETFs. And we have one continuation trade that was taken from yesterday's session that we did not have enough time to report. And tonight I'm going to show you exactly how I did what I did that allowed me to keep the bias to the short side, wait for prices to consolidate, and then take the third and the last trade of yesterday's session so that you can learn how to do the same thing in your daily trading. First, let's talk about the U.S. markets. Across the board right now, the exact level that we laid out 6 nights ago on the Nightly Market Intelligence Report as major support at 13,880 right here has now been hit 2 points away on the close. Now that is exact, and that is really using the correct application of technical analysis to call this level, and that's exactly where the price is hit. So here we have some solid actual proof tonight. Now as far as the levels are concerned, the next level to the downside, because these bars are so well interlocked, and because the volume came in on the Dow, and because it came in on the futures just today, a little after the Dow, but came in today to reinforce the market, new market call from our end, now being net short on a level 6 as of tonight's call. We have an opportunity to get to this level here that was laid out at 13,623 all the way back from 2000. We're excited. Look at the distance of the move that has a high probability of coming right to us. If we go through the indicators, let's take a look at what's happened in the last 2 days of trading. Sure, downward momentum from the shake and money flow here. Next indicator shows on the advanced decline oscillator, it was the first to give us a signal that the market would turn around. And now, since the peak, 2 more days to the downside. Next, taking a look at the Fibonacci ratios that I laid out from here to here, which I barely reveal. This is the target to the downside at 23.6% retracement, where prices could get to and hold and then continue again to the next level to the downside that was laid out at 13,628 that I had just talked about. The next indicator I want you to see is the MACD. We had the early warning out of the MACD right here on the trend line violation. Here's the cross. Now take a good look at the spread, the distance between the MACD and the signal line itself. The disparity is becoming wider and wider, and this is why we use this indicator, because it is not only a trend following indicator, it is a momentum indicator as clearly indicated here of what is in play at this moment on the last 2 sessions to the downside, confirming the market has changed direction. Expert market timing is all about the best of the best indicators and using these in a way to determine what the higher probabilities are, in this case a negative divergence, before the prices ever turn back around, clearly indicating that the smart money had traded out of this and it was just a matter of time before these prices had started to fall and put us exactly where we are today. So let's get out of the Dow and let's take a good look at the continuous contracts. First the ETFs, and then we'll get right into continuous contracts here. Okay, let's switch the screens and we'll get right into that. Okay, we had talked yesterday about gearing up for a short sellout here. And this is exactly what happened today. Again, yesterday we were gearing up for a sellout on this ETF, and as it turned out, we actually went short. The methodology called it short today. So we covered the long and went short here. And so we got out at 263, which is where we went short on XLF and the 40 financials sector that we're viewing, the ETF symbol traded against it being XLF. Now this has some serious price profit targets at the downside that can be realized, as in here, and then again at a lower level right at this point, and then again here. So these we'll talk a little bit about tomorrow night, and as well the other ETFs we're going to go through right now. So as it sits, we covered the long and went short. A brand new call, short the 40 financials and the ETF symbol XLF traded against it. Next, no call tonight on telecommunication services. No chart pattern setup, no real indicator setup, no smart money volume. Next on here, 30 consumer staples sector. If this sector turns out to be defensive in nature, where the market falls off, we are at the right place at the right time, and we made the right decision to go long. If it doesn't work out, we'll be out of this sector, and the ETF symbol that you can trade against at XLP in a heartbeat, so that we don't give any more money back than is necessary. Okay, so again, we're long tonight on 30 consumer staples and the ETF symbol XLP traded against it. Here, if we take a look at healthcare, yesterday we were long with a closed stop. Now that'll change because of the substantial move in the futures before the equities actually opened. The overnight session on the futures side, traded down sharply. So we knew as soon as the equity session opened that these sectors and the ETF, the related ETF symbols, would trade down. And that's exactly what here. This gap opened here on a lower price level, and we were out right near the close. So we got out of this today at 513 and wound up booking 12 points on this trade today. And again, long here at 501, cut out at 513. So no new calls after being out today. Here, the one that we were waiting for, the setup, it finally came to play. We're short yesterday on the big move down. Again, short today. We're waiting the money. And so tonight's call is that we are still short, looking to get to a price profit target back to around this level by the open of 115. And that would be an approximated area of 366, 367 would be a great place to get out on a rally. Excellent trade in play. An excellent high probability trade identified by the smart money trading methodology. Next, looking at the 50 materials sector and the ETF symbol traded against it, XLB, right here. We called the short move and stayed short because we felt that it was just a matter of time before the prices dropped. And this is exactly what happened yesterday. The continuation to the downside leads us to a conclusion that we should be able to get to the open here of 1231, and that price level is approximately 247, maybe 248 on a rally. Excellent trade in play, again called by the methodology. Here on the 20 industrials sector and the ETF symbol XLI traded against it. Okay, the smart money exited this trade today because yesterday we were talking about a likely sell-up because of the setup and how the market was turning back around, and finally this sector was going to turn back around and its related ETF symbol as well. So we exited this trade today out at 375 for a 5-point loss, keeping it real small, keeping it as simple as possible. Here, 10 Energy and the ETF symbol traded against this sector is XLE. We went short yesterday on 10 Energy and the related ETF on the smart money bias call, and we remain short. Now, we talked about being here short 609, and so on today's close, 601.50, we're up 8.5 points, and we remain short again tonight after booking 20-point gain in here and out there. Market timing, sector timing, ETF timing. This is the way a professional analyzes it and trades it to make sure that we keep these losses small and we ride these winners until we hit real price profit targets that have been laid out in advance. Here, for example, a lot of times it's good to know exactly what not to trade. This is something I wouldn't consider trading for any amount of money. So as I've said many times in many reports, if anybody's talking to you about investing in information technology, I wouldn't touch this right now. We have no call tonight on 221. And that takes care of the 10 sectors and the assigned ETF symbols traded against them. Let's get out of this and right into the continuous contracts. Okay, here we are. Now, we're looking at a daily chart of the S&P 500 E-mini futures, our preferred market to trade because of the liquidity, the ability to trade it almost 24 hours a day. and the ability to get the fills even in the fast-moving market where we need them. Mark to the market prices are 1503.75. Let's take a look at the money flow indicator. It's clear to see, although different than the Dow, a definite showing after the negative divergence, two different trend line violations. We were talking about this last night. If this trend line got violated by this money flow indicator on a shorter term time period, it would give us an additional signal that we can continue to be short and look to get to price profit targets to the downside, knowing that those higher probability levels on the way down will always be levels that are laid out on the 15-minute charts in advance to know where we stand every single day of our trading. Here, Stochastics Momentum Index that we use specific to us here, the negative divergence that was formed from this data point to here, and then the additional cross on the indicator itself, and now from above to below the 80 line and the full downward momentum clearly says our chief market scout to identify market turning points has led us in the right direction. Here, if we take a look at the levels, well, I had a client from Jerusalem, Isaac, in the session this morning, and we were pegged at exactly 1505 on the AM, early AM, before equities opened, 8 some odd change Eastern Standard. Now, we were using support at 1505 as a gauge to see what happened with prices. Today closed through here and then reopened, okay, for the next full session, which we're now in the overnight session, leading to tomorrow's trading at 1504. The next level to the downside stands at 1492.50 right here, as identified by these prices, in particular this one right here, as laid out by February 5th. The next level to the downside will be at a lower area that I'll lay out on the next report coming up Sunday night. So these are the levels, and this is where prices can get to in a short period of time. Again, using these as price profit targets to the downside. Here's your Chaikin advanced decline oscillator, trendline violation, more downward momentum. So all these reasons, based on these time-tested indicators that we're seeing here, add up to a new smart money bias call on the overall U.S. markets short at a level 6. So all the opportunities that we're really looking for on the S&P E-mini trading front are going to be to the short side. You may get trades to the long side at this point on bounces, but the majority of the money is going to be made to the downside, and that's exactly the way it is. So before we get into a real-time demonstration of what I explained earlier about the continuation move that we identified because the smart money came in, and how on the 15-minute indicators it was clear that the short bias could be maintained, waiting for the smart money to come in to take that third trade, I want to introduce you to a classic trader from Canada by the name of Adrian Bickham. Now, Adrian started studying here and went through the executive mentorship program about a year ago, if I'm not mistaken. I don't think it was longer than that. And he ran with me for 21 days straight and has come back a few times afterwards. And he's going to take just a few minutes to talk about his experience here, you know, what he gets out of the report, what he got out of studying here, and whatever else he'd like to talk about. This is unrehearsed. I just asked him if he would be kind enough to come in and say a few words for us. Adrian, are you there?
I am.
Okay, well, go ahead and just take a few minutes, and feel free to talk about whatever you'd like to discuss tonight.
Awesome. Well, I want to take the opportunity to say thank you very much for inviting me out tonight, Jeff. And it has been less than a year. I believe we actually took the mentoring program in May of 2012, April, May, and around that time. So it hasn't been quite a year. But I wanted to share with everybody the experience that I had between what I was doing before I met Jeff and what I was doing after. I've been trading for about 7 years now. I trade options, call options, put options, and with some mediocre success. In 2008, I did quite well, but then I continued to give money back over the markets back to the markets over those years, getting increasingly more and more frustrated. I ended up reading an article, kind of ran into Jeff's an article that he wrote, and I can't remember who it was for, but once I read the article, I knew this was the guy I needed to learn from, because this is a tough business. This is not easy. It may look easy to people because you just buy when it's down and sell when it's high, or sell when it's high and buy when it's down, but there's a lot more to it than just that. So anyways, I sent Jeff an email, and I told him I need to get this figured out now. So we talked over the phone. I signed up for his mentoring program. We went toe-to-toe for 21 days, and since then, I have taken his education and I have applied it to not only the sector, not only the Dow Jones, but I've also included the sectors and as well as the equities that are underneath those sectors. And I have to tell you, there is nothing better than knowing when you're watching these setups and you're watching these indicators fire one by one as you're watching the prices, you know what's going to be happening over the next couple of days. The probabilities are in your favor, and your confidence grows exponentially knowing that you're getting in at the right time. And especially when it comes to options trading, because those who do trade options understand that timing is imperative, even more imperative than just trading straight equities. So because of the timing, the superior timing with these indicators, the returns have been nothing short of spectacular. So I just wanted to share that with everybody. As you continue to learn, if you're thinking about taking, some classes from Jeff, I highly recommend it. You're not going to be sorry. He's gonna go through a lot of stuff with you, but you keep your nose to the grindstone, keep practicing, you keep learning, and eventually it all comes together for you, as it has for myself. And so I'm really excited to be here tonight. I'm really glad I was able to share this information with you guys tonight.
Well, Adrian, excuse me, I thank you for the positive comments. I do, and I've known you for a long time, and I know where you started. I know where you landed. Yeah. I think the most important thing for anybody, a new trader, intermediate, or even advanced trader, to understand is that, as you learned, as everybody learns who comes through here, is that the most important thing in trading is to let these trades come to you.
Absolutely.
We have to wait for these high probability setups. We have to wait for these trades. We can't just take any trades. We have to take the best of the best trades, because when we do, we can load up. Yep. And we can make what we really need to make. And then when there's nothing there, we stand on the sidelines, right? This is the way it should work.
Absolutely.
Right? And so this is why we're so selective about the trades that we take, and we really need to have a lot of volume behind those trades. So with that, I'm going to get right into the presentation of the third trade that was taken yesterday that we didn't have enough time to cover yesterday. So before I get into this trade, what I'd like to do is back up just a little bit so you can see the flow of what happened here. Now, here was the second trade. Now, the white line was a price profit target to get out at on a rally that was based on a 15-minute chart level, because the 15-minute charts are the mother of all time frames to trade intraday, although we're using the 1-minute chart to get in and out with precision. Okay. So because of the volume that came in here, and it's so clear to see if I blow it up at this point, right, on a close, below this level right here, this is really where I wanted to be in. And so when prices traded down and down and down with a close stop above here and then traded down, something I didn't reveal last night is the trend line that I had connected from this area down. And so prices hit this level. Here's your blow off to the downside on a 1-minute chart. Prices trade back up, back down. They trickle sideways. Now the money flow indicators are starting to move up. And so the trend line gets violated on the 1-minute chart. And because it got violated and the 15-minute chart money flow indicators were starting to trade up, that was the reason, the perfect reason, to get out of this trade right here. So when we talk about really where we want to be We want to be at the right place at the right time to get in, and then we want to get out. And we don't want to hang around, because I definitely don't want to give this money back. When you're sitting in a trade for 30, 40, 50 minutes and starts going against you, there's a psychological element that comes in that says, you know, what do I do next? And that element is confusion. So we need to eliminate the noise and confusion by following the rules and following the methodology. So when a trade starts to give some money back or it goes against you, you get out. And you look for the answer later. Now, let's take a look at something else here. Now, to the next trade. Okay. Before I do this, I want to show you what I'm looking at on the 15-minute indicators and why this was the area to get in right here. And let's get the data window up here so you can see what I'm talking about. Okay, right here. This was the area I got back in. Okay, and this bar is about 1402. 1520.25, because here's the level. It's perfect. Setup's great. 15-minute indicators say go. I'm looking for the best of the best trades. I got 50 contracts I'm trading. I get in, prices turn right back around, and I get stopped out with a point loss. How is that possible? Well, it happened. It's business, and I don't want to give you any illusions. We're going to get stopped out. This is the way the business works. Did I like it? No. Did I accept it? Yes, because I know that I'm balanced. If I keep doing the right thing, I'm going to make out at the end of it all. And so what happens here is that this level gets crossed again to the downside, but this time with a gap to the downside, indicating the weakness that wasn't evident earlier. And the 15-minute indicators that I'm going to show you right now, right here, here's the level to be crossed at 15:20.50. The EMAs never looked back. They were clear to be short if the setup was there. Here's the noise and the confusion that came in looking for a direction. I'll show you why there was such a disparity from the high to the low in just a minute, but here's the level that was laid out. The level gets crossed here. Next, after the strong negative divergence, here we are. Here's the level to be crossed again to get into the third trade after the two trades here. The MACD never looked back. It got close here, but the trend was still moving to the downside on the 15-minute chart. Stochastic's momentum indicator was clear, never crossed above, signaling we could stay in the trade to the downside and get another move if the volume came in. Here, I want you to see something that a lot of traders weren't looking at. Here is where prices were stabilized. This is where the smart money came in for the glorified pump. Divergence analysis kicks in, levels are set. Remember, all these levels were hit on the way down that I laid out on a report a few days ago. All these levels were hit on the way down on the numbers. Okay. Then the smart money comes in here for the sell-off. This is where it comes in, 10 a.m. So, where is this level? This level here is a critical level where prices get to, and here's the large spike that comes in with the extreme high and low, looking to get through this level to the downside, and it finally happens here. Why does it happen here? Why was the disparity so wide between the high and the low? Because this was the critical level that the smart money came in for the pump, the sell-off, and then here is the big dump right here at that level to cement the deal that the prices can now go lower. Can now go lower. All we need is the crossing below this level right here to be 100% sure. Money flows in good territory to the lower region. Here again, lower region. Before the third leg is taken. And what happens? There's your level. There's the volume. Got stopped out. I thought this was it. I was sure it was it. Price turned right back around. Here's the gap down, and that's why I'm in again with this volume here behind it at 1850 at 1442 hours. This volume that came in here was something that propelled prices much lower than I had ever expected. I couldn't be sure at that time whether this was going to be the breaks that would stop at this level on my price profit target or not. But I got to the price profit target that was laid out from a 15-minute chart at 15:14.75 at 14:57 hours to get out on the target at a rally shortly thereafter, actually on the low of the bar right here at 14:57 hours. I think that's the first time I've actually gone out on a low on a 1-minute bar in about 3 months. So that was actually a gift. It should have been 14:15, but it turned out to be 15:14.75. So that's how the deal went. And so this is the way to stay in a trade when we have the daily charts all set up for the big moves to the downside. And when we have these days, load up and make a substantial amount of money in a short period of time. This is the way it works. This is true high probability trading. We spent a lot of time tonight preparing this report for all of you, so I certainly hope that everybody has learned a lot from this. And so at the end of it all, this trade brought in 3.75 points. You saw the in and you saw the out. Again, trading 50 contracts because of the strength of the downtrend. It was $187.50 gain per contract. So the total net gain in the trade, the dollar gain, was $93.75. Now, if you take out the $2,500 that was lost here because it was 50 contracts traded, lost a point for $2,500, we walked on the loss minus the gain for a total of $6,875. And that doesn't include the previous two winning trades at 1.25 and 0.75 points on one trading day. This has to be one of the biggest trading days of the smart money trading methodology. My pleasure to present all this actionable intelligence to all of you tonight. For any information regarding the Ninja Trader platform, you can just go to theinsidetechnician.com. For any information on any of the courses that we sell here, these very comprehensive courses, you can go to the website under the course category and see the Expert Market Timing course or the S&P 500 E-mini Elite Trader Training course. We'll see you next Sunday on the Nightly Market Intelligence Report. Good night.